JP Morgan is tightening its grip on the silver market. The silver market is shifting underneath your feet right now, and most investors have no idea it's happening. While everyone debates gold prices and Fed rate cuts, something quieter and potentially far more significant is taking shape in the silver market. The biggest financial institution in the world is deepening its control over a metal that powers the global energy transition. And if you hold silver, or you're thinking about it, you need to understand exactly what that means for your money. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you are actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Let's start with something that most mainstream financial media glosses right over. JP Morgan Chase is not just a bank that holds silver positions. It is, by virtually every credible measure, the single most powerful institutional force in the silver market on the planet. To understand why that matters so deeply right now, you need to go back about 15 years. In 2010, JP Morgan inherited a massive short position in silver when it absorbed Bear Stearns during the financial crisis. At the time, that position was so large it represented a staggering percentage of the entire global silver market's annual supply. Critics, analysts, and traders watched with fascination and alarm as JP Morgan sat on that position for years, suppressing, in the view of many commodity market observers, what silver's price might have naturally discovered on its own. Then something changed. Between roughly 2018 and 2022, JP Morgan quietly and methodically built one of the largest physical silver hoards ever accumulated by a single private institution. Estimates from commodity analysts and COMEX vault reports placed their holdings at various points above 150 million troy ounces, a number so large it is almost difficult to conceptualize. To put it in perspective, total global silver mine production runs approximately 820 to 850 million ounces per year. JP Morgan, at its peak accumulation, was sitting on nearly a fifth of that annual production in physical metal. That is not a passive investment, that is a strategic position. Now here is where the story gets more nuanced and more important for you as an investor. JP Morgan has not simply been holding silver. According to COMEX vault data and delivery records tracked by independent precious metals analysts, the bank has been actively involved in the settlement and delivery mechanisms that set silver's price. The COMEX exchange in New York is technically a futures market, meaning most contracts are never settled with physical metal. They roll over, they cash settle, and the paper price becomes the de facto global benchmark. But when one institution has the physical inventory, the vault infrastructure, and the trading relationships to dominate both the paper and physical sides of that market, they hold a form of pricing leverage that goes far beyond what any normal investor experiences. What's changed recently is that this leverage appears to be tightening rather than loosening. COMEX warehouse inventories have seen irregular and notable drawdowns in certain categories of registered silver, the metal actually available for delivery, while the broader eligible category, metal stored in COMEX vaults but not yet committed for delivery, has fluctuated in ways that suggest increased demand for physical conversion. At the same time, the London silver market, which operates largely through unallocated accounts and over-the-counter trading, has shown premium spikes on physical silver that analysts interpret as signs of genuine supply stress beneath the surface of an otherwise calm headline price. This matters because price discovery, the process by which a market figures out what something is actually worth, is only as reliable as the market structure behind it. When one institution controls a disproportionate share of physical supply, dominates vault infrastructure, and participates heavily in futures positioning, the question of whether silver's spot price reflects genuine supply and demand fundamentals becomes a legitimate and serious one. This is not a conspiracy theory. This is a structural market analysis question that professional commodity traders, mining company executives, and institutional portfolio managers discuss regularly and openly. Adding another layer to this story is what's happening with industrial silver demand. Silver is not just a monetary metal or a store of value, it is an irreplaceable industrial input. Solar panels require silver, electric vehicles require silver, medical devices, water purification systems, and the semiconductors inside nearly every piece of modern electronics require silver. The Silver Institute, which tracks global supply and demand with a level of rigor few other commodity research bodies match, reported a structural silver supply deficit for multiple consecutive years, running into 2024. That means the world consumed more silver than it produced from mines and recycling combined. When deficits are persistent, inventories shrink. When inventories shrink, whoever holds the physical supply holds the pricing power. JP Morgan understands this dynamic better than almost any institution on Earth. They have the research teams, the commodity trading desks, the vault infrastructure, and the balance sheet to position themselves across multiple scenarios. Whether silver prices rise sharply, consolidate, or experience volatility, JP Morgan's structural position in this market allows them to profit and influence outcomes in ways smaller investors simply cannot replicate. And this is the setup, the foundation beneath the story that every silver investor needs to sit with before making any decision about their portfolio. Because the question is not just whether silver will go up. The deeper question is, who controls when, how fast, and from what position? If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. Now let's go deeper, because the JP Morgan story is only one piece of a larger structural picture that is developing simultaneously across 3 different continents. The second major force reshaping the silver market right now is India, and its role is growing faster than most Western investors realize. India has always been a significant consumer of silver. Unlike Western investors who tend to think of silver primarily as a financial asset, Indian consumers have a deeply cultural and practical relationship with silver that spans centuries. Silver is used in religious ceremonies, gifted at weddings, worn as jewelry, and increasingly purchased as a savings vehicle by a middle class that has limited trust in paper financial products and limited access to sophisticated investment accounts. But what shifted in recent years goes beyond cultural demand. India's government and financial regulators have been making structural changes to how silver is priced domestically and how it flows through the financial system. For years, there was a meaningful and persistent premium between the international silver price and the price Indian buyers actually paid in the domestic market. This premium, sometimes reaching double digits on a percentage basis, was driven by import duties, currency dynamics, and distribution inefficiencies. That premium created arbitrage pressure, but also suppressed some portion of demand, because silver was simply more expensive in India than the global benchmark implied. As some of those structural inefficiencies have begun to ease, and as India's financial markets have matured, institutional silver demand from within India has started to more accurately track and respond to global price signals. That means when silver becomes attractive internationally, Indian buying now amplifies that signal faster than it used to. The mutual fund angle is equally significant. India's Securities and Exchange Board has been expanding the framework under which Indian mutual funds can offer commodity-linked products, including silver ETFs. Silver ETFs launched in India in 2021 and have attracted growing retail investment from a population that is simultaneously becoming wealthier, more financially literate, and more suspicious of currency debasement. Silver ETFs in India don't just represent financial demand, they represent physical demand, because Indian regulations require that silver ETFs hold actual physical silver as backing. Every rupee that flows into an Indian silver ETF translates into real metal that must be sourced, vaulted, and accounted for. As that market grows, it competes for the same physical silver that industrial users and Western investors are already competing for. Now layer on top of this the byproduct mining dynamic, which is one of the most underappreciated structural constraints in the entire silver story. Approximately 70 to 75% of all silver mined globally is not produced by primary silver mines. It comes as a byproduct of mining for other metals, primarily copper, zinc, lead, and gold. That means silver supply is not directly responsive to silver prices. When silver's price rises, primary silver miners can increase production relatively quickly, but the majority of silver supply is controlled by base metal miners whose production decisions are driven by copper demand, zinc prices, and their own capital allocation priorities, not by silver's price. This creates a supply inelasticity that most commodity markets don't face. You cannot simply drill more silver wells when demand spikes because most silver doesn't come from silver wells. And this is where most people stop reading, stop watching, stop paying attention. But the ones who stay are about to understand something that could completely change how they see their money. The structural deficit that the Silver Institute has documented is not a one-time event. It is the result of years of underinvestment in primary silver mining, the byproduct supply constraint, and an explosion in industrial demand that was never fully priced into the long-term capital expenditure plans of the mining industry. When the solar energy build-out began accelerating, when electric vehicle mandates across Europe and China started taking effect, when data center construction began requiring more silver-containing electronics than any prior forecast anticipated, the mining industry was not positioned to respond quickly. Mines take years to permit, build, and bring to production. The lag between demand signal and new supply response in mining is measured in half decades, not months. What this means practically is that even if silver prices rise significantly from current levels, new primary silver supply cannot flood the market overnight to resolve the deficit. The metal that exists in vaults, in ETFs, in institutional holdings becomes strategically more valuable. And whoever controls the largest concentrations of that vaulted, deliverable physical silver sits in an extraordinary position of market influence. JP Morgan knows this. The sophisticated commodity desks at major sovereign wealth funds know this. The question the rest of us face is whether we understand it clearly enough to act on it intelligently, not emotionally, not reactively, but from a place of genuine structural understanding. The COMEX stress signals are the third piece of this picture, and they deserve careful, honest analysis rather than the breathless catastrophizing that sometimes surrounds them. COMEX has not defaulted. London silver settlement has not broken. Anyone telling you a collapse is imminent without clear, specific evidence is speculating, not analyzing. But the signals that are present, delivery demand spikes, registered inventory drawdowns, premium differentials between physical and paper markets in certain windows, are real data points that professional traders watch closely. They don't prove manipulation. They do prove that the physical and paper silver markets are under more stress than the calm headline price often implies. And understanding that disconnect is genuinely valuable information for any investor trying to build a clear picture of where silver actually stands. Here is the part of this conversation that matters most. Not the fear, not the hype, not the theory, but the clear, grounded, actionable understanding that you can actually carry forward. The silver story, stripped of all its noise, comes down to three converging realities. Physical supply is structurally constrained and cannot respond quickly to demand increases. Institutional demand, from India's growing ETF market, from industrial users in the energy transition, and from strategic holders like JP Morgan, is compressing the available float of physical metal that's accessible to the broader market. And the pricing mechanism, particularly through COMEX and London, is dominated by institutional players with resources, infrastructure, and information advantages that retail investors don't have. Understanding those three things doesn't mean you should panic. It means you should be thoughtful, deliberate, and honest about what you're actually buying when you buy silver. I want to be clear. I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. If you are a long-term silver investor, the case for holding physical silver as a portion of a diversified portfolio is genuinely supported by the structural supply and demand data. Multi-year deficits, inelastic byproduct supply, and rising industrial consumption are not speculative arguments. They are documented, verifiable market realities. That doesn't mean silver will double next year. Markets don't work that cleanly, and anyone who tells you they know the exact timing of a silver price move is either guessing or selling something. What the data does support is the view that silver is structurally undervalued relative to the demand trajectory building beneath it, and that the risk of holding no exposure to it may be higher than most investors currently appreciate. If you are newer to silver investing, the most important first step is to separate the credible structural arguments from the emotional and speculative noise that surrounds this market. There are voices in the silver community who have been predicting an imminent COMEX default or a massive short squeeze for 15 years. That prediction has not materialized on the timeline they described, and treating it as inevitable is not a sound investment framework. What is sound is understanding the real supply deficit data, the real industrial demand trajectory, and the real institutional positioning, and building a position that reflects those realities without betting your financial security on a dramatic near-term event. The second actionable step is to think carefully about the form of silver exposure that matches your actual goals. Physical silver coins and bars held directly gives you direct ownership of the metal with no counterparty risk. Silver ETFs give you price exposure with high liquidity but without direct metal ownership. Shares in silver mining companies give you leveraged exposure to silver prices but also expose you to operational, geopolitical, and management risks that are specific to each company. Each form of exposure has a different risk and reward profile, and the right mix depends on your time horizon, your portfolio size, and your personal financial situation. There is no universal right answer. There is only the answer that fits your specific circumstances honestly and clearly. The third takeaway is perhaps the most important one of all: position sizing discipline. Silver can be a meaningful, intelligent part of a well-constructed portfolio. The data supports a real structural case for the metal, but silver is also volatile. It has historically experienced drawdowns of 30, 40, and even 50% during periods of dollar strength or risk-off market conditions before recovering and moving higher. A position size that lets you hold through that kind of volatility without panic selling is a position size that can actually deliver the long-term benefit the structural case supports. A position size that causes you to lose sleep, check your phone at 3 a.m., or sell at the bottom because you need the liquidity, is a position size that works against you regardless of whether the long-term thesis is correct. Silver's story right now is genuinely compelling, more compelling than it has been in years. When you look at the full picture of JP Morgan's structural positioning, India's accelerating demand, the byproduct supply constraint, and the persistent industrial deficit, the smart money has been building this picture quietly, patiently, and without announcing it on social media. The question is whether you'll take the time to understand it clearly enough to make a decision you can stand behind, not just when silver is rising and every headline is positive, but in the moments when it pulls back and the noise gets loud. Your financial future belongs to the investors who stay calm, stay informed, and stay grounded in what the real data actually says. That is what this channel is built to help you do. Every single video, every single week. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.